right now, this very second. Warehouse managers in Shanghai are staring at nearly empty shelves. China just depleted 86% of its silver stockpiles. 86%. In October alone, they shipped out 660 tons, the highest monthly export ever recorded. That's enough metal to fill 22 double-decker buses. And here's what most people don't realize. This is not a glitch. This is not random market noise. This is stage 3 of a 4-stage pattern that has repeated throughout history. Every single time, the same sequence plays out. And every single time, most people only wake up when it's already too late. By the end of this video, you'll know exactly where we are in that pattern, why this time is worse, and most importantly, what you can actually do to protect yourself and potentially position yourself to come out ahead. Let me walk you through the 4 stages. Stage 1 is establishment. The system gets built, everyone trusts it. Supply seems reliable, prices are stable, it feels normal, it feels safe, nobody is worried. The institutions managing this system tell you everything is under control. Rules are clear. You believe them because for years, maybe decades, they were right. Stage 2 is manipulation. This is where invisible leverage quietly builds. The real supply is weaker than anyone admits. But instead of acknowledging that, the system prints paper claims, paper promises, financial derivatives, promises to deliver something that might not actually exist in sufficient quantity. Leverage grows, confidence stays high. Most people have no idea the foundation is rotting underneath. The system looks normal on the surface, but stress fractures are spreading through the walls. Stage 3 is the squeeze. Reality starts to crack through the denial. You can't ignore it anymore. Supply actually runs short. People who thought they had access suddenly find doors closing, prices spike. Whoever is in control starts making moves, halting exports, tightening rules, changing the terms mid-game. Institutions that ignored the warning signs are now scrambling. It's chaotic, it's urgent, and it's terrifying if you don't understand what's happening. Most people wake up here. Right here in stage 3, when it's almost too late to act. Stage 4 is the break. The system fractures. Rules change overnight. Paper promises get settled differently. Old contracts don't mean what they used to. The official story diverges completely from on-the-ground reality. There are suspensions, delays, forced conversions, or outright refusals. It's sudden, it's brutal, and if you're prepared, it's actually an opportunity. If you're not prepared, it's a disaster. We are standing in stage 3 right now. But here's why this topic is uniquely dangerous, and why you need to pay attention. Most people think of this as just a commodity, a price chart, a betting game for traders. Wrong, completely wrong. This is the backbone of modern life. Solar panels, every single one of them needs this. Cell phones, electronics, medical devices, industrial manufacturing. The entire renewable energy transition depends on this metal. You cannot substitute it easily. You cannot print it into existence. Physics doesn't care about your policy. And here's what is happening to supply. Mexico and Peru, together they are responsible for 40% of global production, are signaling potential policy changes that could restrict operations. Labor disputes and environmental regulations have already disrupted major mines. The result? The market has run deficits for 3 consecutive years. Underground stockpiles are at multi-decade lows. We're not talking about a temporary dip. We're talking about structural shortage, the kind where demand vastly exceeds available supply, and that gap is widening, not shrinking. Let me show you how this pattern has played out before. And I mean exactly this pattern. In 1933, the United States faced a similar crisis, not in silver specifically, but in currency and reserves. There was enormous leverage built into the financial system. People believed their money was backed by something real, something solid. The government promised that everyone who held dollars could exchange them for gold. That was the rule. That was the promise. Then reality hit. The banks didn't actually have enough gold. The leverage was too extreme. So in April 1933, the government changed the rules mid-game. They banned private citizens from owning gold. They called in all the gold. They revalued it overnight. People who thought they owned something real suddenly found the rules had completely changed. Those who saw it coming and acted early, they positioned themselves differently. Those who didn't, they lost. Same pattern, different asset, same ending. In 1971, Richard Nixon announced that the United States would no longer allow other countries to exchange dollars for gold at a fixed price. He changed the rules overnight. Countries that had been promised one thing were suddenly told, actually, the rules are different now. People who had built their entire strategy around those old rules, blindsided. In 2008, we saw it again. Leverage built into financial instruments no one fully understood. Paper promises that couldn't be honored. The system froze. Rules changed. Institutions that seemed solid evaporated. Different decades, different assets, different characters, same exact playbook. And now, in 2025, we're watching it unfold again. But this time, it's playing out in a critical metal that underpins modern technology and energy infrastructure. Here's where we actually stand right now. China's Shanghai stockpiles have plummeted from 5,000 tons at pandemic peaks down to just 715 tons. That's a nearly 90% decline. The Shanghai Futures Exchange shows Chinese silver inventories at their lowest level since 2015. We're talking about decade lows. That's not normal fluctuation. That's a bank run in slow motion. And it's happening because of a twofold squeeze. First, Chinese industry, especially the photovoltaic solar sector, is consuming silver at unprecedented rates. Their own domestic demand is draining reserves. Second, massive exports are flowing out to London, New York, and other Western financial centers. In October, China shipped record volumes precisely because they were front-loading exports ahead of anticipated tariffs and new trade restrictions. Now, here's the critical part. On November 6, 2025, the United States officially designated this metal as a critical mineral. Not optional, not nice to have, critical. That designation changes everything because it opens the door to tariffs, restrictions, export controls, and strategic hoarding. And China just made its move. At the end of October, the Chinese Ministry of Commerce announced new export controls taking effect January 1st, 2026. Only large state-certified companies producing at least 80 tons annually will be granted export licenses. Smaller players, shut out. This creates a de facto quota. Officially, they say it's for environmental protection. In reality, it's a choke point. It's China centralizing control over a global supply of something the entire world depends on. The market is already reacting. Physical premiums across Eastern exchanges are hitting multi-year highs. That means people who actually want to hold the real thing are willing to pay significantly more than the official spot price. That's the market screaming that something is broken. That's real scarcity showing through. Approximately 75 million ounces have flowed into U.S. vaults since October. Why? Industrial users, investors, institutions, they're all scrambling because they can read the writing on the wall. If tariffs hit, if restrictions tighten, they need to secure supply before the door closes completely. This is stage 3. Inventory drains, rules tighten, access becomes uncertain, prices spike, panic buying accelerates, and we're standing at the door of stage 4. Here's what stage 4 looks like when it arrives. Suspended trading, export halts, warehouse closures, outages that last days, weeks, maybe longer. Rationing, or worse, forced conversions where you own something on paper but can't access it physically. Official prices that look one way while actual bids in the real market look completely different. You walk into a store or you try to buy something, and the fine print says, sold out. Indefinite delay. Conditions apply. The promises made yesterday don't hold today. People who prepared, they already own the physical reality. They're not relying on promises. They're not exposed to counterparty risk. They're protected. They might even benefit. People who assumed it would be fine, they're calling customer service. They're discovering that their exposure is frozen or valued differently or simply inaccessible. Here's your practical playbook. This is what you do. Step 1, understand the difference between ownership and exposure. You can own the actual physical thing, direct possession, or you can have paper exposure through ETFs, futures, or broker accounts. Paper is convenient, but it carries counterparty risk. That means you're depending on someone else, a bank, a broker, an institution, to honor their promise. When the system seizes up, paper can become very difficult to convert back into something real. Real ownership means you control it, period. Step 2, choose a robust, low counterparty risk form. If you want exposure to this asset, focus on simple, recognizable forms. Not exotic derivatives, not collectibles, not complex financial instruments you don't fully understand. The simpler and more standardized, the more liquid it remains, even under stress. Physical in hand is the ultimate low-risk form, but it requires storage and security. Allocated storage at a reputable vault is the middle ground. You own it physically, it's segregated, but it's professionally secured. Step 3. Act while friction is still manageable. Right now, premiums are elevated but still accessible. Access is still relatively open. Costs are high but not yet astronomical. In stage 4, all of that changes. Doors close. Friction explodes. Prices might spike 50, 100, even 200%. Or conversely, things that are hard to buy suddenly become impossible to buy at any price. You want to position yourself before the panic truly sets in, before the shutdown. Step 4. Focus on simplicity and liquidity. Avoid the exotic plays, avoid leveraged bets, avoid anything you don't fully understand. Simple assets in this sector maintain liquidity even when systems are stressed. Complexity dies in a crisis. Complexity means counterparties, promises, and middlemen. All of those fail when stress hits. Step 5. Allocate a reasonable percentage, not everything. This is not an all-in bet. This is not a gamble. This is risk management. Think of it as insurance plus opportunity. A modest allocation, perhaps a few to 5% of liquid assets, depending on your situation, gives you meaningful protection without destroying your overall financial structure. Enough to matter, not so much that you're financially unstable. Step 6. Structure your exposure so you, not a fragile intermediary, maintain actual control. If you can hold physical or have it in allocated storage with clear segregation, you're in control. You're not reliant on someone honoring a promise. You're not exposed to a bankruptcy or rule change that affects you indirectly. This matters more than people realize. In stage 4, control is what separates being protected from being trapped. Now zoom out with me. This crisis in this particular metal is not happening in isolation. It's one symptom of a much larger systemic fracture. We're living inside a system that was built on leverage, on promises, on the assumption that things would always work out. That supply would always be available, that institutions would always honor their commitments, that the rules wouldn't suddenly change. But the rules do change. Supply does run short. Promises do get broken. And when stress hits, the system prioritizes survival, not fairness. This is happening simultaneously across currency systems, debt markets, supply chains, geopolitics, and energy. We're not in one crisis. We're in the early stages of multiple crises converging. This metal is just one of the most visible signs of that convergence. History shows us that systems like this, systems built on excessive leverage and hidden fragility, have an average lifespan. And we're deep into the late innings of this one. The binary choice in front of you is simple. You can recognize the pattern now. You can act now. You can position yourself now, not as a gamble, but as rational risk management. And when stage 4 arrives, you'll be protected. You might even be positioned to thrive, or you can ignore it. You can tell yourself that the system is too big to fail, that the government will fix it, that somehow this time will be different. And then, when the rules change overnight, when supply halts, when promises are rewritten, you'll say, how did this happen so fast? The choice is yours, but choose now, because the door to stage 3 is closing, and stage 4 is not far behind. If this framework makes sense to you, if you're starting to see the pattern, then you need to understand the second pillar of this crisis. Because this is not just about supply and demand. It's about currency, debt, and the geopolitical order that's been underpinning global commerce for decades. That's unraveling too. And that's what I'm going to break down in the next video. Subscribe.